especially in view of Q1. If we look, I think the company has delivered an excellent trajectory on the headline top line sales front. On the margins front, I think the management will explain. But Sikaji and Navinji, it would be pertinent if you can help us with as to what were the salient takeaways of Q1, how the trajectory for the Q2 and second half of FY22 look. We do understand that air cooler is an important segment of Q1 which saw a miss. But if you look at the other building products and the consumer appliances, I think we have delivered a very strong growth. I think our plastic pipe and fitting Trufflo has also done a good trajectory. So keeping Q1 as a base, and in many companies, we by and large the long-term investor believe that the Q1 was an aberration. So with this as a preface, I would request the management to spend initial 10-12 minutes on the opening preface, and then share the outlook as to how the second half of FY22 looks like, and after that, how the outlook for FY23 and FY24 is. Over to you. I would request all the participants to please be on mute so that we can do the efficient conduct of this call and it can be meaningfulness to everyone.
Good afternoon. I'm Naveen Malik. Good afternoon, ladies and gentlemen, and welcome to the Somany Home Innovation Limited Q1 FY22 earning call. I hope you are all safe and healthy. I would like to take you through our financial performance during the quarter under review, following with Mr. Rakesh Kaul, Mr. Sudhanshu Pokhriyal, and Mr. Rajesh Pajnu will discuss the key highlights of their respective businesses. Q1 FY22 was a very difficult quarter for the industry in general on account of the second wave of the COVID-19 pandemic, causing a devastating impact on many lives and forcing many states into lockdowns. SHIL registered healthy growth in Q1 FY22 despite the difficult environment, particularly in the early part of the quarter. Consolidated revenue from operations came in at rupees 342 crore, registering a growth of 85% year-on-year. Revenue for the quarter was primarily impacted by the lockdown. EBITDA came in at rupees 17 crore, having grown from an EBITDA loss of rupees 14 crore in Q1 of FY21. Sequentially, though, we witnessed contraction in EBITDA as well as margins owing to the lockdown and the higher raw material prices. Going ahead, we expect margins to improve on account of relaxation of lockdown and recent price hikes implemented by businesses to address the cost inflation. Profit after tax during the quarter came in at rupees 103.6 crore as compared to loss of rupees 24.5 crore in Q1 of FY21. The reported profit after tax also includes the exceptional items comprising recognition of fair value net gain of rupees 66.11 crore from its investment in HPL, Hintastica Private Limited, on account of loss of control of subsidiary, and recording gain of rupees 34.75 crore on account of slump sale of water heater business undertaking by the company to HPL, then a wholly owned subsidiary, during the quarter ended 31st December 2020. Just to clarify, the numbers which we are talking here are the consolidated numbers. Let me now walk you through our segmental performance. The revenue for the consumer appliances business was rupees 67.6 crore, registering a growth of 55% year-on-year. EBIT for Q1 FY22 stood at negative rupees 5.1 crore, and while it marked an improvement over the negative rupees 8 crore in Q1 of FY2021, it was significantly lower than the EBIT of rupees 7.5 crore in the previous quarter. Profitability for the segment was impacted by the advertising cost that was already committed to, in addition to loss of sale in the air cooler segment and impact of lockdown. The consumer appliances business was severely impacted by the pandemic, but we have started to see promising sign of a recovery from July onwards. We are confident that we will be back to seeing healthy growth in the coming quarters for the segment. Moving on to the building product segment, revenue for this division stood at rupees 265.3 crore, registering a growth of 98% year-on-year. EBIT came in at rupees 15 crore for Q1 FY22, up from an EBIT loss of rupees 9.5 crore in Q1 of last year. Turnover for the plastic pipes and fitting business stood at rupees 87 crore in the quarter under review. The performance of building product segment was impacted in April and May. However, we saw good recovery in the business since June, which has only further improved in July. We expect to see this business back on its high growth trajectory very soon. The revenue of the retail segment, the revenue stood at rupees 9.5 crore, having grown 22% year-on-year. Q1 FY22 was truly a difficult quarter for everyone. However, we remain bullish on our business prospects and are confident that we will bounce back to our growth trajectory soon. We continue to drive our business on the lines of innovation and aesthetics, delivering products geared to improve customers' life, to improve consumers' life. With its rich legacy, our brand Hindware will continue to move from strength to strength, delivering on its goal. We have already seen revival in our business divisions and expect normalcy to return very soon. I would now request Mr. Rakesh Kaul to take you all through the consumer appliances and retail businesses. Over to you, Rakesh.
Yeah, thank you, Naveen, and a very good evening to everyone out here. First of all, I hope all of you are nice and safe. Your families are doing well too. We've seen the worst through, hopefully, through the second wave of the pandemic, and I'm sure that much efforts are being utilized nowadays to see that maximum population gets vaccinated, and hopefully we see through the coming quarters without any uncertainty regarding the pandemic. Let's give it our best shot. So if you see, the consumer business felt the maximum brunt of the second wave, with the demand being impacted badly. The primary reason for this decline was the loss of sales of the cooling products driven by the air coolers and fans in Q1, which is generally a very, very key selling season. In fact, 65% of the annual volumes of sellout of air coolers happens this quarter, and more than 6 weeks in the quarter were badly impacted during this quarter, and which obviously damaged the consumer sentiment, and also there was a significant reduction in demand. Also, at the same time, since majority of the states, it was a state-specific lockdown, even e-commerce was not allowed to sell non-essential items, and majority of our consumer appliances come under non-essentials, and hence even e-commerce, which contributes a significant part of our business, was not able to deliver material to the consumer, hence impacting the business further. However, we take this as a one-off event, and we believe that the consumer appliances will maintain its growth momentum. And you all know that we have historically grown at a CAGR of 30 to 35% and driven by strong fundamentals. We believe that we can continue to maintain leadership positions at various categories on digital and even offline, and like being number 2 in kitchen chimneys overall, and overall being among the top 5 players in the air cooling segment. So we intend to continue with that strengthening of our earlier CAGR growth. We also strengthen our portfolio in the Q1 despite so much uncertainties in the business. We launched 15 new products, thereby emphasizing that we continue to be bullish about this business and we continue to invest in this business. As far as the Q1 performance of FY22 was concerned, our revenue, as Mr. Naveen pointed out, grew by 55%, which the possibility could have been much higher if the air cooling products would have delivered, which did not deliver because of the pandemic. Also, as I mentioned, the second wave had severe impact on the quarterly performance of the business. However, we have seen an uptick in the business in the month of July with the opening of the economy towards the later part of June. We expect the Q2 FY20 to be significantly better than Q1 and helping us achieve the recent growth trend which we have achieved in the past couple of years. As far as the retail segment is concerned, the performance of this business was also significantly impacted because of our large base of franchisee business and our stores, which are just two in numbers now. So delivering a loss on EBIT level, though it was significantly much lesser than what we did last year. And at the same time, this was after two consecutive quarters of delivering profitability in the retail business. However, we are confident that we'll be able to report positive EBIT numbers in Q2 of FY22 on continuation of the back of rationalizing cost, improving efficiencies, and as we have adopted a capital right business model for this business. To conclude, I would like to reiterate that despite Q1 FY22 being significantly impacted, we expect to see our return to healthy growth rates in both the businesses of consumer appliances business and retail. I must admit that the on-ground situation is improving as we are talking by the day, and we are also taking the requisite measures to improve our profitability significantly. At this stage now, I would like to invite Mr. Pokhriyal to take you through the performance of the bath business. Thank you, and over to you.
Thanks, Rakesh, and a very good afternoon to all of you. This is Sudhanshu Pokhriyal. I handle the BPD business. Q1 FY22 proved to be a very challenging time for all the businesses, especially in the month of May. We however witnessed a very sharp revival in our business, which helped register a robust revenue growth of 92% in Q1 of FY20 over FY21. The recovery of the business was aided by increase in real estate demand and home improvement. In the quarter, our efforts was focused on expanding our distribution network and also improving in terms of our customer satisfaction. We onboarded over 100 new channel partners in this quarter and kept them engaged by conducting multiple dealer meets, especially online during the lockdown. We also undertook efforts to assist our dealer partners monitor their ongoing developments and manage their operations in a seamless manner. I'd like to reiterate that over the last 3 quarters, we have actually outperformed against our competitors significantly, continuously for the last 3 quarters. During the quarter, we've also launched 9 new sanitaryware products and 4 new faucet SKUs. In July, we have our mega launch of the touch-free water closet. Again, learning from the COVID period requirement of the consumer. And to aid this touch-free water closet, we will be launching a 360-degree campaign on media, which will be hitting media in the coming week. We are also actively marketing ourselves as a modern, innovative, design-led brand, increasing our presence on social media to continue to strengthen our connect with the millennials. We are leveraging technology and innovation, and that we have at our disposal. We are increasing product consideration and awareness using beautiful design and thoughtful features as a bedrock for all our new launches. We've also refreshed our product displays and in-shop imagery across the stores to increase our brand salience on the retail front. In conclusion, Q1 FY22 was a difficult quarter for us. We are happy with the recovery, which we witnessed in June. This also gives us confidence in knowing that the business has regained its high growth momentum post easing of restrictions. Going ahead, I'm certain that the business will continue to deliver robust growth and help us carve out a larger pie of the market. Now let me invite Rajesh Pajnu to take you through the plastic pipes and fitting business. Rajesh, over to you.
Rajesh, you will have to unmute.
Rajesh, you are on mute.
Yeah, thank you, Sudhanshu. Apologies. And good afternoon to everyone here. Thank you all for joining on this call. The plastic pipes and fittings division delivered excellent growth despite the challenges and setbacks posed by Q1. TrueFlow has grown at a rate faster than that of the industry, with sales more than the doubling over Q1 financial year 21. And it has helped us further fortify our place as the fastest growing pipes brand in the country. Our sales of 87 crores registered a growth of 109% year on year. Sequentially, the growth was impacted due to the second wave of pandemic and subsequent lockdowns. During the quarter, we launched around 30 new SKUs, further expanding our offerings to consumers through our extensive network of around 201 active distributors. As mentioned on previous calls, we are undertaking steps towards establishing a strong connect with the influencer community to help us further accelerate our growth and enhance brand visibility. We believe these measures strengthen our place as one of the prominent players in the pipes industry. We continue to provide training to our channel partners and influencers to help them improve their skills through various certificate courses. Even in these tough times, this strategy of ours has borne fruit, reflected in our impressive growth during the quarter. We also felt the effect of pandemic, but the inherent strength of our business helped us navigate this challenging phase, and the subsequent recovery in June gave us the confidence that we will remain the fastest growing company in this segment. Thank you very much. And I would like to conclude the opening remarks. Good luck.
Thank you, Rajesh. I think his screen has got stuck. Who will be the next in line, Sandeep ji?
So I think we can start with the Q&A now, and all the participants who are interested in questions, I think they can raise their hands and you can.
This was a good opening remark from all the business heads. I would request all the participants to kindly unmute and they can ask the questions, and would request the rest of the participants to please be on mute so that we call out the best efficiency. Over to investors. Sandeep ji, what kind of a capex are we planning over FY22-23? And essentially, this is a pure asset light company, and is the understanding right that this would not require material capex going ahead?
So basically, if you see that today we are, rightly poised on the asset utilization. Given the fact that post demerger, this SHIL vertical doesn't have plants. In terms of the overall capex at a group level, SHIL and Briloka together, they will spend around 15 to 20 crores each. But broadly, these expenses are on two parts. One is the development of showrooms, in the market. We develop a lot of display centers along with our dealers. Second, and big investment is towards the molds, which is on the consumer side. When we design a product, we patent a product. The design is ours, so our mold is also ours. Other than this, one investment which we already disclosed to the market is on our water heaters on a consolidated basis. But that is a 50-50 JV between SHIL and Atlantic now. Although it's not, it will not be consolidated as such, but it will go below as a item below profit and loss on a quarter-to-quarter basis. So this is broadly the guidance on this. But going forward, we had spoken about this, that when the need arises, we had spoken about the fact that at an appropriate time, let's say kitchen business itself is reaching 400-500 crores. At that particular time, outsourcing may not be fully viable, as such, because the supply assurance is also becoming very, very critical today. And in order to control various aspects, and given the fact that there would be a critical mass, so we may look at, development of those assets or putting up the, capacities at that particular time. But I can assure you that, any further capex, which we do, will be more value creative, in terms of that, the underlying measurement ROCs will be bigger. But overall ROCs, which right now, like in Q4, we had a ROC above 40%, but definitely some ROCs fall will happen, but a lot of absolute value addition will happen on the EBITDA side. So the fall in the ROCs will be traded off with the absolute EBITDA gain on the P&L.
Noted.
I think a few questions are in chats.
Just one second. Sir, I have got one question. Sir, has the competitive intensity across unorganized segment taken a dent, or this is an interim blip, and every time whenever we say that unorganized will take a backseat, after 2-3 months they come back with vengeance? So how is the scenario this time, basically?
So I think market has evolved over last 12 to 15 months. If you see during the COVID times, the presence online for the branded player is much stronger.
Give it to Sanjeev if he has to.
Yeah, Gavin, you have to put on mute, please.
Sorry.
So the demand online, the visibility of the brands online has increased substantially because people sitting at home, in order to buy anything, first they have to look at the Google. They try to Google out anything, and there the play of the branded things come into the picture. But India is a highly differentiated market. There are different demographic profiles. The purchasing power parities are different. So unorganized market will keep evolving over a period of time. But the opportunities which are there for a branded player today definitely has increased a lot because of higher visibility of products online. So we feel that this competitive pressure will continue over a period of time with India, because India has a different subset of underlying criterias, both in terms of earning capacities, per capita GDP. So different people require different sort of products, some based on utility, some based on branding. So, but there is a huge opportunity for brands to evolve, over a period of time and eat away into the unorganized player.
So we have a couple of questions in line. Mr. Amit Jari, you can unmute yourself.
Yeah. Hi, team. Thank you for the opportunity. My question is regarding what kind of cost inflations are we seeing in sanitary ware and faucetware of late, and what kind of price hikes have we taken in both of these two categories?
May I request Mr. Sudhanshu if you can take this question, please?
Hi, Amit. So, in terms of the input price hikes, we've of course seen price hikes, especially in brass for our faucet business, which over the last 12 months has actually increased by more than 50%. We are currently trading at about 470, 480 rupees brass, which was 20 rupees last year July. So, massive price increases happened. However, we have been taking price increases, and let me share with you. And of course, there have been price increases, in terms of all the gas prices have gone up. Most of our utilities prices have also gone up. So what we've done is that over the last, I would say, since January of this year, we've been taking, in the last 7 months, we have taken multiple price hikes. In the month of February, we had taken a price hike of about 3% in sanitary ware and about 5% in our light product division, like fitting seat covers. And again, in the month of June, we've taken a further price increase.
Sudhanshu ji, the voice is feeble. You will have to take the mic near it for the better clarity, please. Yeah.
So, can you hear me better now?
Yes, now it's far better.
Great. Sorry for that. So let me repeat. So we took a price increase of about 3% in the month of February for our sanitary ware products. And we took a price increase of about 5% for our APD and seat cover business. APD is a light product division, for example, which are cisterns, plastic cisterns, and concealed cisterns, which were made for our BPD business. Again, we took another price increase for our sanitary ware business in the month of June, which was to the tune of 5 to 8% for our sanitary ware products, and between 8.5% to 10% for our plastic, PVC cisterns and concealed cistern products. So we've taken a pretty significant price increase because of to pass on these increased input prices. In our faucet business, we have taken a price increase of 9.7% in the month of March, in March. And we are again taking a price increase, which is happening in Q2 right now, which will again be into the tune of, about 9% to take care of this 50% increase in our brass prices. So to answer your question, yes, there have been significant input price pressures on us, and much of the price increase has been passed on to the consumers.
Yeah, thank you, sir, for that elaborate answer. My second question is, within the same space, so one of our competition, so we are given to understand that one of our competition who is relying on China for their sanitary ware products is facing some supply chain disruption. So are we seeing any increased traction to our product and how are we placed to capitalize on that, sir?
What we believe is that a lot of our strategies are right now working very well in the market. So our increased traction in the market right now is because of that. We've launched a lot of innovative products. We've improved our customer service in the market. We've also, our campaign "Thoughtful is Beautiful" is doing fantastically well. It's received fantastic response from the consumer. A large part of our traction is because of these efforts. There are reports. I also saw the same report, some time back. However, I believe that competitors are actually impacted pretty much equally from the impact because of Chinese imports. So I don't think that is a key reason for us to do well. That's not my belief. What we believe is that a lot of our strategies have started working very, very well. So I won't really be able to put a figure to it as that we are doing well because of them doing badly.
Understood. And sir, one last question, if I may. Sir, you have also said that in your opening remarks that we are gaining market share in last 3 quarters. So is there any color on, not on quarterly basis, but FY21 closing? I don't know what could be our market share in sanitary ware and faucetware.
So it's very difficult to put a number to this. We believe our market. So there are no syndicated researches which are published in this industry which give you the market shares. These are generally calculated after looking at individual companies' results. We believe our market shares are in the tune of 27-28% in sanitary ware, about 8 to 9% in faucets. So I think also because of COVID, category growths have substantially changed, between one quarter to the other. I think I would be in a position to answer this question much better in Q1 of next year. But I can tell you, looking at results of this company, we are doing far better than many of our competitors. So definitely we will do market share gains. Putting a number to it right now, I think would be premature.
No, sure. So thank you. Thanks for the opportunity, sir, and all the best.
Thank you. Thank you.
Yeah, thanks, Amit. We have Nikhil Gara. Can you unmute yourself?
Yeah, hi, sir. Thanks for the opportunity. So my first question is, when I look at our gross margins for 1Q FY22 and I compare it with 1Q FY21 and even 1Q FY20, we have still done decently on the gross margin level. But we are seeing a very sharp increase in employee expenses. Any specific reason? Have we given some salary hikes or we have added new people in the system? Can you help me on that, please?
So if you see, definitely there are some price the salary hikes because last year the hikes didn't happen because of the COVID thing. But we have done hikes as per the industry standards in those range. But apart from it, if we see the bigger chunk of an employee percentage, you will see is definitely on account of the lower sales. When you have lower sales because of the COVID, the salaries keep paying on. So on an overall basis, the percentages they increase. Then Nikhil, have I answered your question?
Yeah, Nikhil, are you there? I think so. We have lost it.
Hello.
Yeah, Nikhil.
Sorry, sir. I just lost the audio. I did not get the answer. Can you please repeat it?
So you had two questions. One, was there any increase in the salary hike? So there was some salary hike which has been given across the company because last year employees didn't get any hike. And also on account of loss of sales due to the COVID, the percentage employee cost as a percentage to overall sales look higher. These are the two reasons which I can explain to you.
Got it, sir. And sir, in this specifically in building materials, so sometime back we had uploaded a presentation where we had mentioned that we are planning to launch a separate vertical for faucets. So just wanted to understand what is the strategy over here and why the specific reason to separately launch a vertical. Just wanted to get your mind share on it.
So if you see sanitary ware, it's almost 4,500 crore market. Faucet is touching around 9,000 crore market. So if we have seen that when you verticalize a particular thing, the deeper focus comes into the play. And once the deeper focus is there, the growth element starts playing into the whole picture, and the incentivization of people, incentivization of the teams do help us, to achieve the faster growths into the market.
So are we trying to say that we will have a separate distribution team and a separate branding and completely
No, no,
separate
no, no.
business?
So this is no, no, no. These are only a part of verticalization is there. So backend teams, they all report to Mr. Sudhanshu. So internally they were already segmented. We have put in more focus into it. So Mr. Sudhanshu is leading the overall team there, and everything reports into him only.
I can add to this. What we do is all our back end, all the brands are all common. It's just that faucet by nature is a more distribution led product in comparison to sanitary ware, which is largely a dealer led product. So if you want more distributors to make a significant progress in this, we wanted to have a separate team or a separate vertical opening distributors for faucets, and that's what we have done.
Got it, sir.
Everything else is common now.
Got it, sir. And sir, just sticking to this faucets question.
Nikhil, can you just come later? There are a lot of questions already.
Sure, I'll just come back.
Thanks a lot. Yeah. Next we have is Mr. Chetan Gindoria.
Hello, sir. Thank you for the opportunity. Sir, my question primarily is with respect to what are the trends that we are seeing with respect to overall demand in the building material segment, especially in the month of June and July now. So in July, have we reached back to our this March and April levels, and how do you see the building material segment growth over FY22?
Yes, so I'll request Sudhanshu and Mr. Rajesh Pajnu if you can address. This is a market-related question. I think you're the best guys to answer this.
So I request Mr. Pajnu, maybe he can take it first.
Yeah, that's fine. See, there is a traction, and the market has, particularly in June and July, they have started coming back to their normal course, and it seems that. Especially with how we are looking at it, is like Q3 and Q4 are going to be too good and too promising. The demand is going to be there. The projects are going to get completed, and new projects are going to come there in the market, which have already been launched. So we see if nothing unforeseen comes in the way, we see that third and fourth quarter are going to be as good as they were in the previous year.
Yeah, I totally echo what Mr. Pajnu is saying. But for, of course, the impact, if at all, of the third wave, if it comes, of course, there's so much of news around that. Yeah, but for that, I think we are seeing steady demand, and back to the pre-second wave numbers. If these averages continue, of course, the numbers will be pretty.
So whether July is basically, are you saying July is back to what it was in month of March?
The demand, like I said, we are going back to pre-COVID levels. Yes.
Okay, you already seen going back to pre-COVID.
Yeah,
okay,
going very close to pre-COVID levels. Yeah.
And the same thing for consumer business as well.
Yeah, hi Chetan. Yeah, as far as the consumer appliances business is concerned, we are seeing a turnaround from the later part of the June month, because overall the consumer facing businesses also got impacted of e-commerce as well, which has become a major significant contributor, primarily because of non-delivery of non-essential items because of the state-wise lockdown. Having said that, we're looking at July in certain categories. We're seeing a huge demand recovering back to the levels of definitely of around January, February, for sure, in the month of July.
January, February. So basically, when you say January, February and not March, basically.
No. When I say January, February, I meant Q4.
Okay.
Yeah.
So things are coming back to normal.
Now, because there is so much of uncertainty around what is exactly the normal, But what I can say is that the demand is looking up, the business is looking back to the quarter 4 levels. That's what I can say. It's very difficult to say whether it's all normal because, as we are sensing around us, there is still a lot of fear around in the minds of the consumer for shopping out. Those fear is still there. So I wouldn't say that things will return back to normal, but the business is looking up in a different fashion. We as businesses have also customized ourselves to reaching out to consumer in a different fashion, whether it is through D2C channels or whether it is through the alternate channel route or the omni channel route. So we have also devised and customized our way of approach, how to reach our consumers in a different manner and not just depend purely on when the shops are going to open full throttle and we achieve our pre-COVID level of business.
My second question is at the company level. What is the total raw material cost increase and what is the percentage price increase? I'm taking it as a blended basis because there are too many segments. So I'm not asking segment wise. I'm saying at the company level. And in the second quarter, do we see full impact of the price increase and therefore as you go back to fourth quarter levels in terms of revenue, whether we should assume EBITDA margins and profitability also coming back to fourth quarter or better?
So in terms of the overall increase in the input raw material prices, and I'm talking basic raw material prices, like for pipes, it's the PVC resin. For faucets, it is brass, and also the fact that when we talk consumer product, we use plastic, steel, copper, everything. So on an average price hike, we can assume is somewhere around 30%, as such. A part of it is passed on, and this is when I say 30%, it's a blended rate on an approximation basis, because then the weights also have to be assigned to each other, and this is year-on-year basis, and a lot of it has been recovered. I'll say that some part of the recovery will still happen in Q2, and because prices are still firming up as such. So these are the ranges I can advise you today on this, but these are ballpark numbers.
Great, sir. Thank you, sir. I'll come back in queue.
Next, we have Mr. Dikshit Doshi.
Yeah, can you hear me?
Yeah, please.
Yes. Yeah, thanks for the opportunity. Just one question from my side. This water heater business we have transferred in a slump sale basis to subsidiary. So let's say last year, full year, our consumer business was 455 crore. So how much was this water business contributed in that sales?
So broadly, I can answer your question in percentage. So if you net off water heater last year against this year, because this Q1 didn't have the water heater, so our consumer product business, which in the results you see a growth of 50%, that should be somewhere around 65%, 66%.
Okay, and this JV will only manufacture or they will only do the sales part?
So they will do the full business, manufacturing as well as sales. Plus, apart from it, since the JV is with Atlantic, which is one of the very large French companies, they have their other bouquet of products, which will introduce into India. And not only that, we have now rights to sell our products into various SAARC countries. That also, increases and enhances our opportunity in the international markets.
Okay, and one last question. Once this COVID thing settles down, let's say 2-3 quarters down the line, what could be the steady state, EBIT margin, at least in consumer and building product, if you can mention?
So if you see on a Q3, Q4 basis, our consolidated EBIT margins, so they were in a range of somewhere around 10 to 11%. So we have given a guidance that this will further enhance over a period of time. Going forward, we have given that EBITDA margins in a range of around 15% and on an overall product portfolio in 3 to 4 years time.
Okay, fine. That's it from my side.
Thanks a lot. Now we have an action line, Mr. Pritesh Chheda. Hi, Pritesh.
Yeah, hi. Hello, sir. So I have one question on aspirationally, we wanted to control or bring down the working capital cycle.
Yeah.
Now with so many vertical heads and each having its own demand, how do you foresee reduction in working capital cycle, and who should be entrusted with the job of making sure that the working capital cycle aggregate at the company level reduces?
So these are three distinct verticals inside the organization, because that is one key mantra which we have learned for growth. If you see the success of our pipes, if you see the success of our consumer products into the market, because is a separate verticalization. The inventory of one division has nothing to do actually with the inventory of the other division. Each of the businesses have their own set of targets in terms of bringing it down. In the month of March, we were having an average net working capital cycle of around 100 days, 105 days. So which we have given a guidance in next 2 years, we are targeting that we should be able to bring down by 15 to 20%. A part of the businesses are our growth businesses, wherein the focus today is more on the growth side, because we don't want to lose our sales in just by optimizing the inventory. So, but I understand at the same time, we have to be optimized. So the focus is there, and each business has a focus. So it consolidates at a group level also, in terms of consolidation. But each businesses work along very closely with the respective support departments so that they optimize the inventory. So, but despite this inventories, and the receivables which we have, as we are growing substantially, our ROCs, as I told you in March quarter, although this quarter is not measurable in the right context because of the COVID thing, was 40% plus.
But at the aggregate, so
that is aggregate. I'm telling you.
No. So my question was actually on the working capital only. When you say that few businesses are in growth mode, this has always been the case with our company for so long. So we have been continuously adding verticals of products. If that's the case, then the 15-20% reduction in working capital is at the company level after factoring your growth aspiration, or you would have a situation where eventually you might think through that, okay, I am growing, so there is no need to reduce the working capital. So communication to shareholder is at aggregate, including all the growth aspirations that you have.
Yes. So when we are making a communication to the market, it's on a consolidated basis.
Okay.
But if you see, I'll answer your question in a different manner. Let's say if we are growing at 40%, like consumer business, historically, the CAGR for last 2 to 3 years has been 35%. Pipes has grown substantially given the small base. Now it has become a critical mass. So their growth rate has been even, 60-70% plus. We lost some markets on BPD, but now the recovery for the last 2 quarters has been pretty good. So it's not a single lever that the focus is only on inventory reduction. So you can reduce the inventory any day, any time, but the first focus is improving the sales, improving the growth. But at the same time, we try to control and see on a day-to-day basis how the inventories can also be optimized. So that is why we are not given an aggressive target to the market on an overall basis. And this is spread out over next 2 years. Actually, we are not saying that we'll do everything in next quarter or something.
Yeah. My second question is on the sanitary ware side. There few players have talked about supply issues. Maybe they would be imported as well. So are we facing any supply issue, and how is our supply situation or structure set? How much is in-house manufacturing for us, and how much is outsourced, and do we import anything?
Sudhanshu, may I request you, please?
Yeah. So, we buy 70% of our sanitary ware from our SHIL.
Yeah.
And about 20-odd% in the previous years, 21-odd% was coming from China, and about 9-odd% from domestic suppliers of sanitary ware. We've seen some unprecedented price increases, from China, also because of tripling of ocean freight. And there was a lot of uncertainty around our imports during the COVID period from China. So as a conscious strategy, we reduced our dependence on China, and it's actually come down by nearly 6 to 7%, in the last, I would say, 5 to 6 months. And our contribution of Chinese imports in our total business is less than 12-13%. As we speak, and we got delayed deliveries from China, but we got our deliveries. So we had our issues in the earlier part of the quarter, but in the later part of the quarter, in around June, we got most of our deliveries. Thankfully, in May anyway, we had a lockdown, so we did not really face that impact in a big way. So to answer your question, yes, there were issues for us as well, but we were able to mitigate it also because of because of the fact that we got our deliveries in the month of June. There are hardly any major supply issues in the domestically procured or supplies because of HSIL supplies. So largely, I would say, I won't say we are like 100% okay, but we are 95% there. So that's to answer your question.
And where are we on the lost market share on the sanitary ware side? How are we looking at gaining it? Or
no, like we said, we have now for the last 3 quarters been growing faster than all our major competitors in the sanitary ware business, and we have been able to do that because of a whole host of changes which we've brought about. We are focusing a lot on innovation, innovative products. We've corrected our pricing in the market. Our schemes are, the way we go to the market to our dealers, the way we settle our, their claims, the way we have been servicing them in terms of, the commercial hygiene with the dealers, in terms of their product deliveries, OTIFs as on time in fulls, in terms of the orders which they place. So every single operational parameter for us has improved significantly in the last, 3 quarters. And in my view, that all these things combined have really helped us in terms of beating the market in sanitary ware and also in faucet business. All the competitors in both the businesses in the last 3 quarters. And I mean, God willing, we would be in a position to do that in subsequent quarters as well.
okay. My last question is at the business model front. Since last few quarters, we are talking about scale increase at the total company level, and corresponding operating leverage followed by margin expansion.
Right.
Is there any change there on the path? Any hiccups or challenge in achieving that path as an aggregate company? And I usually get worried because our aggregate company is then sub parts into 3 or 4 different vertical, and I always get worried how 3 or 4 different verticals might have their need, which might jeopardize or the aggregate company level path. So processes.
If you see on an overall basis today, there are 3 focus businesses, and each of this business has a historical trajectory of growth. Although Mr. Sudhanshu has talked about now sanitary ware faucets also coming back because we are beating the market there now. So based on the current market situation, we don't feel there are hiccups today, but definitely wave 3 or something of this situation happens. May I request others to please take it on, please. Rajesh Ravi, please. Mr. Rajesh Ravi, please, if you can take it on mute, please. Yeah, thank you, please. So we are confident that the path is right. We have given a guidance to market, which has been well communicated, both in terms of the margin expansion, both in terms of this. So, and if you see historically, whatever we have spoken about, I'm not saying last 1 year or so. You can check our old records also from what we have spoken. The directionality of what we are doing and the directionality of what we have been speaking is almost the same. Only thing is that some part of the businesses have got delayed due to the COVID impact. We lost some turnover last year, we lost some turnover this year. But other than this, actually we are walking on the path and it's a well-defined path.
Okay. Thank you and all the best to you, gentlemen. Thank you very much.
We take the next question from Deepak.
Thank you very much, sir, for the opportunity. So I just wanted to understand, like over next 2 years, how do you see the revenue scale up in terms of maybe CAGR and some sort of aspirational margins? I understand you said 15% over next 3 to 4 years. So something on next 2 years, if that you can throw some light, yeah, that would be helpful. That's it from my side.
So this is a journey, if you see our EBITDA margins, consolidated EBITDA margin Q3, Q4, Q3 was somewhere around 11%, Q4 again 11.5%. And on a call, we have said that, if the situation is normal, our margins should remain in this trend. There can be some flip on, flip offs, due to the price changes, input raw material price changes, and the delay in the pass on. But we are internally working on various efficiencies. We are working on product mixes so that, new product introductions like consumer, we have talked about the IoT products, and we expect the share of IoT products to increase. Operating leverage, we have spoken about. So that is a journey. And overall, in terms of how and where we are about to reach in 4 years, that guidance also is there in the market. So if you see historically, I've also given a guidance in a sense that the historical track record of consumer business has been somewhere around 30-35% CAGR, over last 2 years. Pipes have shown a growth. Now building product is also given a growth. So we feel that on an overall basis, on a all company level, in next 2 years, we should have a CAGR of 20% plus based on the current market conditions.
Fair enough. And in terms of margins that you explained, now 15% in next 3 to 4 years, and maybe currently 11.5% when situation normalizes. So next 2 years, maybe somewhere in between 12-13%.
Yes, because it is not that all of a sudden we will have 11%, from 11 to 15.
Correct.
So margins will keep expanding 0.5% on a quarter to quarter, or 1%, depending on how the market behaves. But this is our directionality, and this is what the whole organization is working towards.
Yeah, that's quite helpful, and that's it from my side. All the way best.
Thank you, Deepak.
Thank you, Deepak. We take the next question from the person with the name iPhone. If you can identify yourself also, please. iPhone.
We can move on to
the next Sonal Minas. Sonal, can you unmute and ask your question, please?
Hi, sir. This is Sonal Minas. Can you hear me?
Yeah.
Yeah. So directionally, just wanted to understand, between the two businesses, the building products and the consumer, what is it we can actually aspire to achieve our EBIT margins in a steady state? And I have seen the business, the building product business, when it was a merged entity. Back then, we were roughly around 16-17% of EBIT margins for the building product business. So, where should we be now? Because we are parking some margins in the manufacturing business. Correct me if I'm wrong there. That's one. And the second thing is on the consumer business, where if we are, let's say, hitting at what top line we should actually see margins stabilizing, and what should be those margins?
First question is on the building products, which is more on sanitary ware and faucets. I understand that. On a pre-demerger basis, when we were part of HSIL, the consolidated margins were somewhere around, EBITDA margins were somewhere around 20%. EBIT margins are slightly down. So what we leave as a part of our contract from an outsourcing is ranging between 4-4.5% on an EBIT level basis to HSIL. But as we build the volume, the operating leverage does come into play, which will lead to the efficiencies both on the employee cost, on the marketing efforts which we do, the supply chain cost. So there will be unlocking. I'm not saying unlocking of 2% on a single head. So we have different cost heads. Even a 0.25%, 0.5% in each one of them. will lead to a substantial value addition on the bottom line. As far as the answer to your questions on the consumer side is concerned, so consumer got into a fairly good position in Q3, Q4. They had a good EBITDA margin and EBITDA margins ranging somewhere between 8 to 9%. Again, the build-up, the business has not fully been scaled, and also the fact that in March quarter also we lost some air cooler turnover due to the COVID, which was there in Maharashtra and other places. So we feel when we have given a broader guidance of EBITDA on an overall 14-15% in next 3 to 4 years. So we see that 2 to 3% margin expansion happening on the consumer side also from the normalized situation.
Got it, sir. And sir, just seeing the way things are right now, I think forget how COVID would be. The guidance that you've given for growth for the next 1 or 2 years is 20%. If I may just reiterate that what you summarized to the previous person who was asking the question. Just want to clarify that.
20% plus, 20%. Around
20% plus CAGR. This is what it is. 20%
over next 2 years, 2.5 years.
Okay. If I may just sneak in another question, if I'm allowed to.
Yeah, please.
Yes, sure.
Sir, just wanted to understand basically what would we be aspiring from the JV, and I don't think so that is going to hit your top line because of I don't know shareholding, but from a very simple strategic perspective, that what's the business plan for that business like for maybe next 1 or 2 years? If you could just summarize maybe 1 or 2 bullets there, that will be helpful.
So I'll answer the first part of the question in a different manner, and then I'll request Mr. Rakesh Kaul, actually, who runs this business, to answer your second part, how the objectives of the business is going forward. If you see in consumer product, we developed this business right from 2015.
Yes.
And we did a EBITDA level investment in 3-4 years of somewhere ranging between around 55-60 crores. The first part is that by unlocking the value, we have brought back the value onto the platform, given the fact that there is a substantial upside in terms of the valuation of the business when we did a JV versus what we had initially invested into it. So we got a good valuation, and now we are redeploying that valuation to set up those facilities so that next level of valuation can be worked on, or we can work on building the business further stronger with the bigger margins. So that was a broader objective of doing this JV, because we feel that once this JV starts production and achieve a particular size, there will be definitely expansion of gross margins in this business. And this will further lead to a very healthy, product portfolio, because there are other portfolio products into the portfolio of Atlantic, which now we can introduce into India. Rakesh, although this was very short from my side, would you like to extend this, please?
Yeah, thanks, Mr. Sikka. So yes, primarily, when we moved into the JV with water heating business, as Mr. Sikka has pointed out, the other categories which are going to be a part of this JV is obviously going to be an electrical heating. And we have some very, very superior products in electrical heating from our partner. We have also recently introduced very high-end energy efficient heat pumps, for which the market in India is significantly increasing because of better energy efficiency and not having water heaters in each of your individual bathrooms. And that's also a market which we are looking up to with a lot of comfort, because we believe that we have our strengths in those channels to reach out to. As far as the business plan and the objectives are concerned, I think the primary focus in this category has been, or for that matter, for all the consumer appliances category, is that we want to be among the top 3-4 players within 7 to 8 years of the launch of that category. An ambitious plan, given the fact that the leaders in the top 3 currently in each of these categories are players which have taken them 3 decades or 2 decades or even 20 odd years to reach to that level. Our business plan, the GfK report of 2021 says that we are in the top 6 in water heaters by volume, giving us an approximate market share of 7%. We believe in the next 4 to 5 years, our target is to be among the top 3 players, to be a strong number 3 or number 2 player, and achieve a stable state market share of between 13 to 14%. So that's what we are looking in the next 4 to 5 years. and also expanding our margins at the same time through our in-house facility, which will come out in Hyderabad in the next 14 months, and also stabilizing our product and innovation on IoT and innovation on connected appliances, smart plugs, which will set us apart from the competition. We believe there's a significant upside to this business in the coming years, given the fact that we have a strong partner with a strong technological background as well. I hope that answers your question.
Yes, that's it. Thank you. Thanks a lot.
Thank you. The next question is from the next question we'll take from Shrey. Shrey, could you unmute?
Hi, thanks for the opportunity. So this is Shreyans from Quest. So just wanted to understand. So you mentioned that you would like to reduce your dependence in the building product. So am I getting it correctly that you would want to reduce your dependence on HSIL for your procurement?
Sudhanshu, if you can answer, please.
No, Shrey, what I said is that I want to reduce my dependence on China for sanitary ware products.
All right. So secondly, sir, sanitary ware, we were trying to gain our market shares back. So just wanted to break your sales into B2B and B2C. So just your thoughts on where is the higher growth opportunity that you're seeing, and what are the steps that you're taking to achieve that?
Yeah, so we get about 30% of our business from institutional business, and 70%, of course, comes from retail. I believe that equal opportunity exists on both the segments. Of course, they address very different consumer needs. Your B2B business is largely a new home construction with large projects, while a retail sale is largely a replacement demand, or maybe a small home dwelling which requires your bathroom products. So there are equal opportunities on both sides, largely not just because of the fact that there is growth and demand in the home segment, but also because of the fact that there is potential in the overall economy, because there is upgradations which are happening from people are spending more money in terms of their requirements for a more premium bathroom. So there are potential which exists in both the segments. So what we are doing largely from the retail side, first of all, what we're doing is in terms of creating a pull for the brand. So what you see is this campaign, Thoughtful, which we rolled out first time in Q3, Q4 of the previous year. And what you'll see again is the second phase of that campaign, which will start next week. And that is being, the campaign is spearheading a launch of a new product, which is in the touchless one piece, as we call it. It's a water closet product, which is in one piece. So a new one piece water closet being launched, 2 models, which is being under the brand umbrella of Thoughtful is Beautiful. So the number one thing which we're doing is, of course, strengthening our brand Hindware, to bring the consumers back into our fold of the brand Hindware. Second, like I said, as a consequence of Thoughtful, where as part of a team, we are looking at extremely new innovative products. To just name a few, touchless water closets is one such example, where the only other product which existed in the market for touchless was from us only, which was at double the price, at about 27,000-28,000. We've actually brought the prices down through internal value engineering to about 15,500 two models. And this is we've got a fantastic response from the trade for these new launches. And it's like touchless products are extremely in need for the consumer in the COVID times as well. So the second part of our strategy is, of course, innovation. The third part of the strategy is distribution expansion. We believe that there are tons of outlets in the industry which are, I would say, even if the products are reaching there, they're not reaching in. It's not a quality reach. It's not a high quality reach. You don't have adequate representation of all our subcategories, all the kind of products which we want to sell in markets. So distribution is the third big opportunity. So we are working on distribution, and we are increasing our brand stores, which provide a very high quality reach for our stores. And also we are increasing our distributors, which will ensure basic availability of our products in the market. So that's the third thing which we're doing. And of course, on the fourth side, we are becoming extremely customer focused, and which entails that high degree of customer service, high degree of focus on resolution of issues, complaints, and also high degree of product availability. We are focusing extremely highly on operational efficiency for our business. So these are the four things which we are bringing about in our retail business. On the institutional side of the business, what we are looking at is, we've created a team of 100 people. We've expanded our team by double. We used to have about 48 people in H1 of previous year and before that, which were focused on institutional business. Now we have about 100 people who are actually focused on institutional business. So resource allocation on the institutional business expanded substantially. We are able to reach much larger number of architects and influencers, and through them we are able to get larger business. Of course, there are a lot of work happening again on operational efficiencies in terms of automation in the institutional business. The catalogs are getting digital, and we're reaching, because of digital catalogs, because of the fact that we are able to offer even earlier products which perhaps have also been discontinued in the retail business. We can offer those at much attractive prices in the project business. A lot of such innovations are happening, which are giving us operational efficiencies and I would say competitive advantage over our competitors as well. So these are the few things which we are doing. Both the segments, I think opportunities exist in both.
All right. So just last bit on the consumer appliances front. So you, Mr. Sikka, I think mentioned that the JV is free to launch their own products as well. So just wanted to understand, are any products going to be in line with what we are already doing in the kitchen appliances side, or the parent side, with the technology that they have?
Rakesh, please. Rakesh, you're on mute.
Yeah. So I think when Mr. Sikka talked about expanding the product lines, he only meant what is available in the Atlantic's global profile. So, and that is, Atlantic is one of the world's 3 largest players in heating, ventilation, and air conditioning. So all the product lines, what we talked about, are strictly not conflicting with SHIL's product lineup as such. So SHIL will continue to market the product lines which we are currently marketing. And as far as the JV is concerned, the focus will be largely on water heating, the electrical heating, and the heat pumps which we have already introduced into the country.
So do you plan to get the products that are there globally into the Indian markets with the technology that they have?
Yes, of course. I mean, as I just recently pointed out that, we will launch electrical heating panels, which are towel warmers, products like towel warmers, products like, ceramic heating, products like tankless shower panels, products like heat pumps, which range from 150 to goes up to 400 liters, which are highly energy efficient products. So I think these are the products which are already available from their international product stable line. And while, we don't intend the volumes for those products would be smaller at this point of the time. So the route will be largely imported to start with, till the time we are able to get a scale on these product lines.
So any timeline for that?
I mean, electrical heating is going to get launched for this season for sure. And heat pumps, as I just said, that we just launched before the second wave. And you will definitely see some more visibility around that product. As far as the other innovative products are concerned, for tankless shower panels and other products, energy efficient products, we intend them to launch next year.
Okay.
FY23.
So just last bit. So I assume that water heating was a high growing category for you in the consumer appliances space. Now, if that moves into the JV, would you like to talk about the guidance on the consumer appliances side? Because I think we've guided for about 30% CAGR.
Yeah, I mean, I would like to retain that guidance as given by our group CFO, primarily for the fact that even in consumer appliances business, which sits out of SHIL, we have high growth categories like kitchen appliances, where we have really grown from being no one in last 5 years to being a strong number 2 player in kitchen chimneys. Much remains to be added in terms of growth in kitchen hobs, built-in products, food waste disposers, built-in dishwashers, counter-tape microwave ovens. Also, we recently launched a very, very big category where the market opportunity is close to 11,000 crores, which is fans, where we are launching some of the state-of-the-art products as well. And so the opportunity is also there. So we are also water purification, where we are at this point of time a fringe player, but the market opportunity to grow there is also substantial. So I don't see by water heating business moving on to the joint venture, I don't see that the growth plans of SHIL will get suffered on that account.
All right, that helps. Thanks and all the best.
Thanks.
Thank you. We take the next question from Puneet. Puneet, if you could unmute yourself, please. Puneet has also texted his questions. He just wants to know the capacity utilization of building products and the breakup of retail and project channel and region wise of building products.
I think this has been answered. We don't have a capacity.
Yeah, so
that is done.
So that, yeah, and the distribution. So that is, we've taken all the chat questions. Sonal, you have a follow-up question? Your hand is raised.
If I am allowed to, I can ask. If I can ask
please,
a question.
you can go ahead. Okay.
So, just a question on the balance sheet. I just wanted to understand how are we servicing the debt and like any plans or any business plan for the debt to be off the books, or we will still have some working capital debt going further.
So Briloka today is debt free. Almost we have a small long-term debt, but our investment into mutual funds, which is a debt mutual fund, which is a surplus money, is still higher. So, but SHIL has some debt. So in next year or so, I think we'll accumulate substantial cash on an overall basis, on a consolidated basis. So if on an overall if you see net debt on an overall basis will be very, very less.
Okay. And so just asking a little bit of a philosophical question on this one. So just trying to understand that let's say there are some more challenges at a macro level, maybe COVID or supply disruptions going further. At a very core level, like the leadership is here. So just want to understand, there are companies who basically gun for speed or keeping their pace of sales, and the working capital or the channel basically becomes stuffed up, and that shows up in the future years. Whereas there is the other side, there is financial prudence, where we say that, listen, this is the demand for this quarter, I'm going to live it by the way things are, and we will respect if the demand has actually gone down, but I will preserve my working capital going further, and give and acknowledge whether the times are good or bad. So just want to know, philosophically, which side are we going? And I think a gentleman before me asked a question around the working capital. You've given guidance there, but what are we doing actually internally to understand, to actually bring that down? Just want to understand that actually.
So I'll answer this question first part and then maybe request Mr. Rakesh call. So if you see primarily, if we shift our vendor base from China to India in next 2 years, because when you do China, you have a Chinese New Year, you have a transit time delays, you have a product build up time, or the ordering time, ordering manufacturing time in China. So you are able to cut down substantially your inventories and your ability to make your product more on just in time basis, rather than you need to stock and then sell. So this just by shifting the basis from China to India, it can lead to a full capital efficiency. But
that has effect on margins, sir. Like, so that is the flip side of this trade-off, right? If I'm not,
it is not that you see the freight cost and other things. Everything is evolving today. So I cannot comment on the margin. I'm just commenting on the working capital today right now.
Got it. Okay.
Okay. So businesses actually, if you see on a realistic basis, similarly as Sudhanshu also said that you are focusing on more Indian based, as we are doing 20% from there. So when we do 20%, we have to stock the inventory. So these are some of the initiatives which we are doing. we are also deploying a lot of digital technologies so that our S&OP processes are getting more and more robust over a period of time, so that sourcing is more dependent on the time frames and the end markets which we are trying to. Sorry, on the background we have some Independence Day celebration outside, so the clapping will be there. Pardon me.
Okay, no worries so much for that.
So these are the initiatives which internally we are doing. Rakesh, will you like to extend this?
Yes, I mean, you said it partly right. You said it right, actually. So as we evolve the business, yes, I think we have to look from the supply, the imports from two perspective. One is from the range perspective, that what is the designs on offer and what is the range perspective, and also from the sourcing ability perspective as far as India is concerned. Look, I mean, without doubt, we know in many of the categories, China is almost 6 to 8 times bigger than India in terms of the market sizes of some of the categories where we are looking at currently, and majority of the categories where we're looking at. So obviously, given that scale, you will always have price benefits from that country, which was very, very clear earlier. But having seen in the past 2 years what has happened, particularly after the COVID and what all happened in the geopolitical tensions, we believed that and not only does it make beneficial to look at building inward capabilities in India. One is to deter any influence of any external influence which is beyond our hands, which is like relationships between the countries getting sour. And on the other hand, what we have also seen is that as we are building capabilities in India, we are also seeing there are massive price fluctuations or increases on the other aspects, which was never a part of the scale, which means ocean freight, which means currency fluctuation. So I believe that in given a space of 2 to 3 years, at least for the categories where consumer appliances business is in, largely our kitchen appliances, we believe that in 2 to 3 years, we'll be able to achieve, within 2 years, we'll be able to achieve the price scale which the Chinese manufacturers are giving. And once we achieve that within that 2 years, that price scale, the other benefits of ocean freight, currency fluctuations, go to market, will definitely make our business much more smoother and much more efficient. So we'll get into a much more capital efficient model as well. Having said this, I must also tell you and inform you that we recently started our local manufacturing for kitchen chimneys and kitchen hobs in NCR region. And we believe that in next 3 odd years, our import content for that larger kitchen appliances business will come down to from the current 90% of kitchen appliances to around 15 to 20%. At the same time, we are also very happy to tell you just within a span of 12 months, we have completely turned around the supply chain for our furniture retail business, where the dependence on imports was to the tune of 60% and 40% was imported. We flipped that around and now we are 85% domestic and 15% imported. And you can already see in Q2 and Q3, the retail business, which had never actually made money for the past 11 years, has started turned around. And we believe that this is a time to scale up that business further because our go-to-market will also become efficient, given the fact that we'll work on a lower inventory and faster to go-to-market strategies will help us in doing that. So I see within the next 2 to 3 years, economies of scale and other external factors making India production a much bigger and a better story.
Got it. Okay. Thanks a lot for your answer. Thank you.
Thank you. We have one question sent by chat is, can you share the breakup of revenues between bathware and pipes? And what is the growth outlook for these segments?
I think growth outlook we are given for Q1, 87 crores is the pipe sales. So building products, segmental reporting, overall building product sales is already reported. And that
the outlook.
Outlook is already shared, in the respective. Yeah,
so that then takes.
Yes, one question.
Yeah, please, Sahil.
Yeah, thanks. So I just want to know your thoughts on this FGV Hindware JV. So what is the current contribution from that segment, and how do you see this segment next?
One, it is not a JV; it's a strategic marketing tie-up, and I would request Mukesh to answer, please.
Yeah, I mean, given the fact that FGV is a global, among the top 3 players in the global arena in the kitchen and furniture fittings business, along with Hetic and Hafele, and they are also the prime time suppliers to some of the world's best and biggest players like IKEA. In India, we have a strategic arrangement with them, and we signed this off in just before COVID, to a couple of months before COVID. And they got a very superior range of the products from which we source currently from their Italy and China factory. And there's a huge potential for this business, given the fact there's a lot of focus which has come into the kitchen space, particularly after the pandemic. And we see that particularly and also in our, so this becomes a part of our kitchen appliances verticalization, where already 30 to 35% of our retail channels are already into selling modular kitchens and modular furniture. So we see a good a sync with that business, and the potential to grow this business significantly in the coming years is there. And FGV, powered by Hindware as a brand, has really started off well in the past 2-3 months. And we see that this business can easily grow at a CAGR of almost 50 to 60% in the coming years.
What is the current contribution?
Sorry?
Current contribution from this segment?
So currently very low, because as I told you, that we just started launching this business just a month before the pandemic first wave. And after that, we were just in the process of opening up with our distribution. So the current contribution to the business is pretty insignificant, would be to the extent of 102% to consumer appliances business. But I see significantly growing in the coming years.
Thank you.
Thank you so much.
Kevin, do we have
Thank
more
you.
questions?
We don't. We have no more questions. We've addressed all issues, subjects. Mr. Sikka, if I could request you to make.
Yeah, thank you, everybody. I think this was very interesting. I think first time we had 100 plus people, so we could only accommodate 100. Maybe next time we'll request Kenin for a bigger conference on a Zoom. Good questions asked, and we really love questions being asked. One point which I'd like to say is that whatever we are saying today was also said few years back, and today we have walked a path to large extent, and the visibility of the path is much more clearer. Few years back, people asked us number of questions, whether it's the right decision to go into this. So today we have proved to the market that we are a substantial player. We are we are emerging as one of the fastest growing organization. When we see into particular categories like pipes, or maybe in some other segments, and now with our sanitaryware also beating the market. So there is a substantial upside, there's a substantial potential, which we feel that we can unlock over a period of time. With all this, again, thanks to all of you. You have been very supportive. You have been appropriately pushing us also with the right set of questions. Thanks again. Thanks a lot.
Thank you so much.
Thank you. Thank you, everybody, for participating. We can close the call. Thank you.
Thank you.